Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do. And so we begin. Today is Wednesday, August 14th, 2024. Today's episode, bullish, bearish. Views are mixed out there, aren't they? You have some momentum traders saying, okay, the Gamma flip line did this, and momentum did that, and Bollinger Band did this, and RSI did that, and we're back to the races. And then you have other technical traders that use trend lines like Gareth Soloway saying that we're in a death zone, of which, if that's correct, I was lucky enough to, if it turns out that that is the case, I was lucky enough to get some October puts on HYG today, very far out of the money, pretty cheap. So if this really is the end, you can have a very tiny portion of your portfolio expand pretty massively if things go that way. But I don't know if it's going to go up or down from here. I'm leaning towards the bearish side because I think Gareth Soloway's crystal ball rating is pretty darn good. But views are mixed out there of technical traders the way that I see it. And but the beauty of it all for me as a bond bull is that bonds don't really care if the market's going up or down. What they do care about is where rates are going. And for now, the market's pricing in 3 cuts within the next 2 meetings. So it's either 2 cuts September and then 1 cut October, or it's 2 cuts, or it's 1 cut September, 2 cuts October. But it's 3 within the next 2 months, any which way you look at it, and then 25 basis point cuts every month after that. A bullish case for bonds that is combined with this is that for a long time now we've been, saying, okay, the first cut is 8 months away, and then a month passes, and then it's like, nope, it's still 8 months away. Another month passes. It went on for a long time. Where it kept pushing it further and further and further away, and then it became 7, 6, and now it's 1 month. Now it's September. We're there. We're at the first cut. So I'm wondering if there's going to be a similar effect to what happened to inflation, where it went up, spiked up, to about 5%, right? Flat, and then spiked up to 9%, and then spiked back down to 3%. Now we're going flat, and now we're ticking down. Are we going to have that last spike down? And if we do, are we going to see also a similar thing going on in the Fed funds futures, where we kept pushing it out, and now we're in a situation where, the cuts seem like they're going to be, orderly, 125 basis cut point every month, or is it going to be a little more disorderly where we see 2 cuts every month, or even more, where we slam it all the way to 0, something like that. I think it's entirely possible. Lynn Allen might actually agree with me on that point. One of her current ideas that goes against her original narrative that inflation was going to stay high throughout the entire 2020s, in other words, for another 6 years, she had been beating the drum saying, the Fed can just raise rates to the moon, and it's just not going to have a very big effect. It might have no effect at all on inflation, and that's partly why inflation can continue to be so high, because the idea is that the Fed, with their rate cuts or their we're talking about increases in the Fed funds futures rate to try to slow down inflation. But that doesn't matter if the Treasury is spending enormous amounts of money, so much money that it just doesn't matter where rates are, and that's called fiscal dominance. And she believes that we have been in that situation. So the thing with that narrative is that there is another side of that coin. If raising rates doesn't have an effect, as a very strong effect on inflation, then cutting would also have less of an effect on keeping the economy from slowing down too quickly, right? It's you can't have it just one way. It kind of is going to go both ways, and so we could easily, in my opinion, see that playing out. At the very least, we need to be able to strongly assume that one 25 basis point cut is not going to suddenly set the the economy back on fire and have unemployment go, straight to zero and everything peachy and inflation then ticking back up where we're just like, okay, we got to keep rates still restrictive or even raise rates from here. It doesn't tend to work that way. I don't think it will. It's not completely out of the possibilities of things that can happen, but I guess we'll see what happens. Like I've been saying in previous shows as well, the Federal Reserve has never engineered a soft landing when it comes to the cutting cycle. They're always behind what happens, and so I fully expect it to be playing out that way at the very least. On to the data and the chart. CPI came out, Consumer Price Index, including food and energy. The last of this over here, I don't have my letters, but this is the last column over here. Middle is expected, actual is on this side, the same way they have it on Market Watch. So the last reading, negative 0.1, expected 0.2. We came in exactly as expected, year over year, including food and energy. It actually went down by 0.1% from the last and 0.1 lower than expected. So we finally did it, folks. We broke below that magical 3% number. We are now at 2.9%. The consumer from last year, according to this data anyway, we are now below 3%. So very interesting there. And then the core, excluding the volatile food and energy, the last was 0.1%. Month over month, the expected 0.2, and we came in exactly at 0.2 year over year. Last 3.3, expected 3.2, and it came in exactly 3.2. So overall, basically exactly the way the market was pricing it. Tomorrow's initial jobless claims, again, this is a weekly report. As Gareth Soloway said on his show today, the last week report of this sent markets flying. It came in better than expected. Less people were filing for jobless claims in the last report to us, to everyone's surprise. And so this could also potentially, it doesn't normally have a huge movement in markets, but this one can because of what happened last week with it. Daily reminder, 2-year, 10-year yield curve inversion is past its second birthday. Sine roll has been triggered. Recession, according to that metric, has started. Did I say has been? Anyway, all right, on to the charts. Weekly time frame of the S&P 500. I just want to bring this up here just because, just looking at it, this looks a lot more bullish than it did before, right? Normally, like as I've been saying, from this high to this high, drawing a parallel, I expected last week to have stopped there. Instead, we broke right through that trend line for, my trend lines, and so, that's looking surprisingly bullish is what I'll call it for now. On a daily time frame, like I said with Gareth Soloway's work, he's a trend line expert. He says we're in this like triangle of death here, and he thinks that this is it. Great time to short. I'm kind of agnostic on the matter at this moment. VIX futures curve I wanted to bring up. I've been noting how crazy this curve has been getting lately. Very notably, the VIX dropped a lot today, but the more interesting part of this is that the October is now, again, more elevated than all of the future months going all the way out to March of 2025. It's even higher than March 2025. Normally you price further out contracts at higher prices because time costs money. And the market right now is seeing basically a very large amount of chaos in October. And, I was a part of this. I bought October options contracts today. I'm a part of this metric, a small part, but I'm not the only one sniffing out October as a potential very volatile time. It seems like the whole market is. The VIX today, if you just look at the VIX itself, we are back to like calm waters today. And some people might say this is potentially the buying opportunity of a lifetime here. If you expect further volatility ahead, while the VIX is this low currently, it's like a very juicy place to maybe get in here. I may add to my bearish positions and maybe get some calls on VXX or something like that. Again, super small position size. I'm talking like 0.1, less than 0.1% of my portfolio. But the thing is, that amount can blow up with options contracts like to humongous amounts. And so if you do time it right, you can do pretty well with yourself using options. But anyway, I digress. Again, HYT here, credit spreads crunching to like so small. High yield corporate bonds, the junk bonds or whatever. I mean, look at where we are. We're at like highs right now. I mean, granted, with rates going down, this will lift junk bonds because, when all yields drop, the junk bonds also drop their yields, and so they can stay parallel to each other. But this is not sniffing out any fear here. The dumbest of the smartest money, I guess, and junk bonds. I don't expect this to hold up, as I don't remember if I mentioned I got some October HYG puts today, expiration in October. HYG also, HYG, so yeah, I get the puts. I do options on HYG because it's a little more liquid. Is this like all-time highs? It's like so little fear here. It's unbelievable. The reason these charts will act different, HYT and HYG, they have slightly different holdings. These funds are not going to hold exactly the same bond. They're junk bonds. They're whatever analyst, whoever is controlling this fund decides is like, this is most, has a high yield and won't, least likely to go bankrupt here. And so, going long, I like HYT because there's a lot more beta, but for options contracts on the short side, I prefer HYG because it's more liquid. Moving on, as I think I mentioned earlier in the video, we were in extreme fear in CNN, fear and greed index, and we lifted into fear. So are we now headed towards greed? This is again why I'm like agnostic on, is the market bullish or bearish here? I'm leaning towards bearish again, but I don't know. I don't know. There's no way for me to know the way I see it. But again, bonds don't care, and this is where my interests lie more than anywhere else, as I have 55% of my net worth in this right now. But anyway, this yield thing, I mentioned it looks like it's rolling over. I've been talking about this for the past several trading days, and it's continuing that pattern as I expected. This is going down, and it looks like it wants to keep going down, and I hope it does, because I'll make a lot of money if it does. But I guess we'll see. I talked about yesterday how, unbelievably bullish the stock market had gotten off of Fed funds futures moving only 3% towards a 2 cuts instead of 1 cut. But today it was funny. It was a little less bullish, but the Fed funds futures actually flipped a lot stronger towards having, going the other way. No, sorry, I kind of said that wrong. It doesn't matter. Point is, we flipped back to having one cut be the most likely thing. I guess it looks like the Fed funds futures was expecting CPI to be a little bit lower here. And it was lower than the expectations from that metric that you see on MarketWatch, but apparently Fed funds futures kind of saw it differently. So, it looks like we are now expecting one cut in September, and more likely than moving. Oh, I said October. There is no October meeting. The next one's November. So then, two cuts in November. And right now, even if you just look at this contract, we're looking. If we have one cut there, then this is expecting one or two cuts. The more likely being two cuts, or even a small chance of three cuts there. So you got to add that 11 to the 45. So it's actually, it's pretty much either two cuts September, one cut November, or it's one cut November to November. And then after the November meeting, 25, 25, 25, 25, 25, all the way through to next summer, it looks like. One other chart that caught my eye today was EWZ, partly because I have like 10% of my portfolio, like as I've been saying in other videos, I'm positioned to take advantage of if the economy like lights up on fire again and things start going to the moon. I do have 25% of my portfolio in stock areas that I think are highly undervalued. Brazil is the most undervalued one of those, in my opinion, and the opinion of many other people out there actually at the moment. But I just wanted to bring up also this chart here. This is very clearly a very, very clear double bottom pattern, which we are now clearly broken out of. So we hit bottom one, bottom two, and you want to see a break above this point, and we did. We broke above. We just keep going up here, and so it would be highly normal and usual for this to at least go up the distance from here to here, from here to here. So that's looking very bullish in the Brazilian equity market from a basic chart pattern. These things play out with pretty high probabilities when you have a setup like this. That's all for today's show. Hope you enjoyed. Thank you for watching Robschild.